Hello everyone, my name is CindyCleaver and I am a CPA with Brown and Associates. I got my bachelor's degree in accounting back in 1997. Started off doing working for the treasurer's office in Wayne County, Michigan. Then did some various different jobs when my husband was in the military and ended up in public accounting. I got my CPA a little over 2 years ago in 2014, and I just finished my master's degree. The firm that I work for, so I have now 13 years of experience in public accounting and 5 years experience doing income taxes. And my boss has over 40 years of experience, and then my coworker has over 20 years of experience. So when you come to Brown and Associates, you don't just get my experience, but you get theirs as well. So really over 80 years of experience in doing business taxes, individual taxes, and such. I try to get a feel for what you guys want me to talk about, so you get a little bit of education when I come and talk. The first thing that somebody suggested was, do I really need to be paying taxes in during the year? The tax system is what you call a pay-as-you-go system. So if you're a W-2 employee, you're going to have withholding come out of your check every week, bi-weekly, whatever your pay schedule is, and your employer pays that in for you. And hopefully you've paid in enough, and the big thing is, I need to get a really big refund. I want to get this really big refund. But is that really a good thing? So if you're self-employed, they want you to be paying that in regularly as well, and they want you to do what they call quarterly estimated payments based on what you think that you're going to earn for the year. Well, what happens if you don't pay in enough? There is a penalty. It's called an underpayment penalty if you've not paid in enough taxes throughout the year, and it is 3%. Now, I say 3%, but it's based on the amount of time, so it's not strictly a 3% penalty out front. To give you an example, one tax return I did last year, the individual owed about $8,500, did not pay in enough throughout the year. Their penalty was $118. That's about 1.4%. Now, the reason that it was not, the 3% is a bunch of different factors. Number one is they did pay in some throughout the year. They had some withholding and they did some other estimated payments, so their full balance wasn't the total tax liability for the year. And the other thing is it prorates it. So it takes what your income is, divides it by 4, and says this amount should have been due by April 15th, this amount should have been due by June 15th, this amount by September, and this amount by January. And it says this amount was overdue now by let's say 200 days, this amount is overdue by 100 days, this amount is overdue by this many days, and so it takes that and does 3% divided by 365 times the number of days. So it averaged out for them to be 1.4%. So at the very most, you would be charged, if you were a whole year, 3%. Is that worth not paying in taxes? Well, that's up to you. Can you earn more than 3%? And if you had that money in a savings account? Some people can, some people can't. I have people that they use the refund as a savings. I want to get a $5,000 refund so I can go on vacation or go buy a boat or do whatever, and so they use it as a savings account. Well, I would say you could use your savings account as a savings account and earn interest on the money rather than the government earning interest on your money. So it's just a matter of preference. I personally play with my withholdings all year, so I either get a $100 to $200 refund or I owe $100 to $200, and I'm happy with that. Some people don't want the government to have their money at all, so they decide that they're not going to pay any estimates and they're going to pay whatever penalty it is and pay it all at the end of the year. Some people will have extra money come out and have that large refund. So it's really a matter of preference. And there's a lot of other rules with it. If you earn your income kind of sporadically, like the bulk of it you earn from January to February, and then you earn a little bit less throughout the year, or vice versa, maybe you earn the bulk of it October to December during the Christmas peak season, we can adjust that income flow so your penalty would be less if you decided or did not end up paying in enough. And then there's also the 90 or 100% rule, which means that if you paid in 100% of your income tax from last year, or 90% of what's due this year, even if you still owed $15,000, there's no penalty because you paid in at least 100% of what your tax was last year, or 90% of what the tax due was this year. So there's a bunch of different factors that that play into whether or not you're going to get this underpayment penalty, but it is just really a matter of preference and whether or not you want to have that penalty or not. Another topic that somebody asked me was, what are the pros and cons of being self-employed? Well, a lot of people in here are self-employed, so you do know what the pros and cons are, but some of you are working for companies and are W-2. Really the biggest thing being self-employed is flexibility, freedom. You are your own boss. What you can deduct. As an employee, I'm an employee, so my travel is home to work for the most part. That's not deductible mileage. It's considered a commute for the IRS, so I don't get a deduction for mileage. If you're a home-based business, as soon as you step out your door to go do a business errand or business work, that's deductible mileage. Most of my expenses are paid for by my employer, but if there were something that I had to pay out of pocket, it's harder for me to deduct those things. It would still be a legitimate expense that I could deduct because it was business related, but I have to put it on my Schedule A, which is limited by 2% of my income. So if my income was $50,000, 2% of that is $1,000, right? Mm-hmm. I didn't do math in my head. I have calculators and computers. But if I don't have $1,000 worth of non-reimbursed employee expenses, then it doesn't benefit me at all. I don't have any deduction. I'd have to have at least that amount. So if I had $1,500, I only get a $500 deduction versus self-employed. If a self-employed person has $1,500 of deductions, it is a straight deduction against their income. So $50,000 worth of income minus $1,000, they're only taxed on $49,000, period. Except for if it's meals, because meals are only deductible at 50%. So that's one of the things. Those are two of the things: mileage and how your expenses are deductible. Now, luckily, as an employee, most of my expenses are paid for by my employer. It covers all my supplies, all of my, if I do have to travel for work, she reimburses me my mileage, so there's not a lot that I do have to pay out of pocket. So the biggest thing with self-employed is the benefit of flexibility, easier to deduct expenses, and then of course if you're a home-based business, you get the benefit of expenses that you would pay either way now being deductible for business. So I own my home. If I do work at home, even if I have an office that's set aside for work, it is very hard for me to deduct that. I would have to be a strictly home-based W-2 employee to be able to do that. As a W-2 employee that has office space in my work, I can't do both. If I was self-employed and I have that separate office space, then part of my mortgage interest, my real estate taxes, my homeowner's insurance, my utilities, which I would pay anyways, are now deductible for business expenses. So those are going to be your advantages and disadvantages of being self-employed. I did have another topic that somebody suggested, but I think I'm running out of time. Sales tax. What is coverable under sales tax? What do I have to pay sales tax on, and what don't I have to pay sales tax on? Well, generally, any tangible personal property and certain taxable services are subject to sales tax. There are a few things that aren't or had a reduced rate. Food is at a reduced rate. A couple other things are at a reduced rate. But like candy, candy's not considered food, so it's not taxable at the 5% specialty rate. But some of the taxable services are gonna be, hotel rooms, services for your auto. So labor is taxable when it is attached to tangible property. So you take your automobile in to get it serviced, the labor, parts and everything associated with that is taxable. If it's labor for construction of a home, that's not considered to be a tangible property, it's a real property, so the labor for that is not taxable. Okay, so that's kind of a general gist of that, and sorry I couldn't get more into that for you, but does anybody have any questions? Yes?
On the first scenario with the paying throughout the year or not, does that put you into any kind of higher risk for auditing? Is that anything to consider?
I've never heard of that. It's generally, as long as you're okay with paying the penalty, it doesn't really create, generally audits are triggered by things that are on your return. The IRS doesn't tell us specifically what they're looking at in returns, but there are programs pull out and look for, this year we're gonna look at this on Schedule C tax returns. This year it's gonna look at this on this, so it's just various things like that, but I've never heard that not paying enough tax would trigger an audit. Yes?
Okay, so I'm kind of I work from home.
Yes.
So I'm a W-2 employee, so I think some of those rules probably cost a little bit. But as far as mileage, where can I start counting my mileage? From the time I go to, let's say I had 30 miles away from our first appointment. Do I have to wait till I get to that appointment to start counting miles, or can it?
Do you go to the office first?
No.
Okay, so what they consider is the first trip from your home is your commute. So
if I
going
go to the
to,
post office per se.
and that's a
miles
business
away.
trip. If you were dropping off business mail, that would be your commute.
Yes.
And then anything after that that is still business related starts to rack up as your business deductible.
Starbucks is not a business related.
Unless you meet a customer there.
Unless you, yes, unless you met a customer there to discuss, yes. Yes.
I'm new to Tennessee, so I've never, they don't have income tax.
We do not have income tax. At the moment, there's a tax on businesses that's not going away, but there is also a tax on interest, certain interest and dividends and capital gains. And that is 6% going down to this year 5%, and then eventually will go down 1% every year till it's gone. So that tax is also going away for individuals, but generally
So
just.
I lived 6 months in Virginia and 6 months here, so I filed for Virginia and I don't do Tennessee.
Correct,
Okay.
yes. Okay, all right, thank you.
Thank you, Cindy.